Antler India. Now, they have actually managed to close their 500 crore of their 600 crore pre-seed investor fund, and this is the Maiden fund, and it's aiming to make the final close this quarter. I've actually managed to speak to Rajiv Srivatsa, partner at Antler India, earlier on the day as well, and let's listen into this exciting conversation I actually had with him.
I think for Antler, we started 2 years back in India, and as part of a global platform, which in itself is only 5 years old, our entire focus has been pre-seed. And pre-seed, what we mean is really being the first check, what we actually call the -1 to 0 journey of the founder. When someone is just becoming a founder, that's really where we want to invest. And we've done that in the last 2 years now, as we have been raising our first fund, and we are in the final stage of closing that fund. So over the next couple of years also, as in the last 2 years, our strategy has been to invest right at that pre-seed stage and be that first partner to founders. We are sector agnostic, we are state specific, and we are also part of the global platform. So for us, I think these are the 2, 3 very specific parts that we stand for the founders.
Okay, you will continue to focus on that as well. A pre-seed investor, your first partner to these companies and to the startups as well. You said sector agnostic, but as of now, every time the situation changes over a period of time as well. What is currently looking attractive to you in terms of application of these funds? Where is it that you think there will be a lot of attractive growth right now in terms of the sectors?
I think for Antler, because of the global platform, enterprise SaaS and building from India for the world has always been a big part of it. It's almost, I would say, 25 to 30% of the current portfolio, as well as the 100 company portfolio that we will have at the end of this fund, will be doing something with respect to SaaS. It could be horizontal SaaS, it could be vertical SaaS. The likes of what Freshworks has done, being a big unicorn in that space. The second part that we are very gung-ho about is the digital public India, in terms of what is happening in DPI, for example, ONDC, OCAN, a variety of frameworks that are coming up. I think UPI was a sort of a seminal moment for that. And we do believe that there'll be a bunch of startups, and it starts with commerce, but it also goes into the fields of mobility. It goes into the fields of health, education. I think the digital public India stack in the next 5-10 years, you will see a lot of evolution. And there's a lot of founders building for that. Outside of that, you see a lot of action on, just global platform stuff like climate tech, Web3, and more importantly, off late in the last 6-9 months, a lot of activity also on AI and AI's implementation in healthcare and education and fintech. So because we're sector agnostic, we're able to see across all of these spaces. And I think as Indian founders, there's a lot of belief today in the Indian founder to actually build from India for the world and really compete in the global arena. And I think if you see a bunch of these spaces, whether that's climate, whether that's AI and SaaS, I think they're all tending towards that.
Right. Rajiv, just want to understand a bit more in terms of, what would be the minimum check size now that, you would be looking for this pre-seed investment, as well as, if you could just highlight a bit more in terms of your current portfolio also that you have, or the investments that you have?
Sure. Our standard check size is anywhere between 2 to 3 crores, the first check that we write. But we also pride ourselves in being a partner to the founder in subsequent stages. So we do continue investing in the seed stage right after our stage, in the Series A stage. And we also have a global continuity fund that also invests in Series A, B, C. So we do believe that even though we come in as the first check, the idea is to be a partner to the founder right across the 5-7 years of their journey as they build up bigger companies. Our current portfolio, I can sort of give you a sampling of, a variety of spaces, right? For example, there's a company called Bookie, which fits right in the vertical SaaS space. Bookie has raised a seed round right after us. And what Bookie does is to really be the ERP for a lot of gym owners in the US. And there are, a couple of 100,000 of them. And can this be, really building out of India a product for gyms and health chains in the US? Completely global revenue, but built completely from India. On the other hand, we have a D2C company, which is called Gladful. India is a protein deficient country. 73-74% of kids are protein deficient because of a variety of reasons. And what Gladful is trying to do is to really help the mother and the kid to have a lot more wholesome meal in terms of protein. And they sell through their own website as well as through a variety of third-party marketplaces. And it's one of the tastiest protein brands that you will ever have. We also have something, in the completely agri space. It's called Cattle Guru. India's milk productivity is 1/6 of what the world's milk productivity is. and what college founders, right? And these are founders who are 20 years old. They're trying to actually change that to make the cows be a lot more productive in the quality of the milk, and by indirect means also help the overall population by having richer milk. So we have a huge smattering, and I can go on in terms of a few more on SaaS, a few more on fintech, but that just to give you a sense of the range of the kind of portfolio investments we do.
Absolutely, you can keep going on, but there's one thing, I always want to understand, because, path to profitability, that's the word, and that's been something that everyone looks at when they keep investing in terms of startup as well. So, what is the understanding, since you talk to so many of them, what is the understanding that you're getting in terms of the path to profitability that they have? And are there any other metrics that you actually look at, while you're investing in these startups, because profitability, yes, that's one front, but what is that other factor that you look at as well?
I think somewhere indirectly this is instilled in our founders right from day one, right? I mean, there are a lot of founders who raise 20 crores, 30 crores, even 100 crores right at the start with nothing else to show. And that's great. But if you are raising only 2 to 3 crores, you start your company, because at the end of the day, to get to early product market fit in the next 6 to 9 months, you really, as a team of 3, 4 people and maybe a couple of engineers, through, putting in some money in marketing, you actually don't need more than around 25, 30 lakhs a month, right? Because you're going to use that money in ways which are not the most prudent. So when you're starting with a capital which is in this realm, which is, let's say, anywhere from 250 to 500K in US dollars, you start with making sure that you have frugality embedded. Second, this is the best time to start companies, because the bigger companies are all cutting costs. The bigger companies are not doing any new initiatives. There's a lot of people who are moving out because of lack of new opportunities in bigger companies. Smart people cannot stay quiet. So they start these companies. And when they start companies in a market like this, they know that it's not going to be easy, right? So which means you get founders who are starting companies for the right reasons, not like 2021 where anyone and everyone could just start companies. So somewhere there is an embedded, that resilience in the founder, because of the kind of founders that start up in a market which is today not the best of markets, at least to start up. Last but not the least, because they are starting up in this market and they know that what the traction they need to get to the next round in terms of funding is a lot more than in a very boom market. They're being very frugal in saving that money for slightly longer and also showing more traction from that same money. When you embed this on day one in our founders, they become frugal for the long term compared to someone who started 2 years back, where frugality has to be a quality that is embedded later on. This is a quality that is embedded in founders that are starting up at least in the last year, this year, next year, till whenever the market becomes boom again.
Absolutely. So, Rajiv, then does that mean with that frugality coming into the startup founders at an early stage, that could lead to an earlier way in terms of the path of profitability that they would achieve as well, compared to the startups that we've seen in the last couple of years?
We do actually very strongly believe, we're all used to unicorns and multi-unicorns and, never doing IPOs for 7, 8, 10 years. I do believe that founders who are starting up now, we have a chance, at least in the next 5, 6 years, to see if the first set of maybe $300 million IPO, $500 million IPO, you don't need to be a unicorn to actually get to an IPO, right? And that's only possible, of course, if you show some level of profitability much faster. And we do believe that at least companies starting today, they don't have that option of showing profitability 5 years out, 3 years out, 7 years out. I think investors also expect founders also have that muscle. And today, it's a lot about building a sustainable, profitable business that can grow consistently heavily, right? And not just show spiky growth up and then a spiky dumb down. And I don't think people or investors prefer that, because it just has too much side effect, in terms of layoffs, in terms of, a lot of money spent, questionable business models. So I think in the overall scheme of things, I do believe that, yes, the path to profitability will be faster, the IPOs will be faster. And overall, I think it just, really helps everyone in the ecosystem.
Absolutely. And Rajiv, just on the broad base, one question, since last festive season, after last festive season of last year, we started seeing that funding winter coming in. Do you think that funding winter now has bottomed out and, obviously better days coming in for the startup world?
I think with respect to the funding winter, you have to look at the later stage and the early stage slightly differently. I think the later stage might take some more time to completely regroup or recoup. There is still a quote unquote funding winter in the late stage of investing, which is, let's say, someone beyond, let's say, 100, $200 million valued, or is raising a Series D or a Series E. I think it's going to take some more time, right? People are being way, way more pragmatic in the kind of funding they will do. And companies, because they spend a lot of money, it's going to take them some more time to get to profitability. It's not an easy chase. I've been part of one such journey as part of being a founder of Urban Ladder, and it takes time to get to profitability, right? But on the other hand, early stage funding, I think there is a lot of capital that is there, quote unquote, the dry powder that is talked about for VCs. And people have certainly started opening that up. There are more pre-seed rounds happening. There are more seed rounds happening. Is it the same pace as 2021? I don't think we'll ever get to that same pace. But is it slightly better than 2022? Possibly, yes. The average ticket sizes are slightly going up. So we are certainly seeing more funding action and traction in 2023 compared to the second half of 2022.
Okay, Rajiv, thank you so much for joining in with us on the show today, giving us an understanding in terms of what your strategy as a fund is, as well as in terms of the industry and how are we expecting things over there as well. Thank you so much, Rajiv.
Thanks so much for having me.